Good evening, everyone. I hope you're doing well. Thank you for taking the time to listen to this video. I hope you get some valuable information out of it. I wanted to give you an update on what's happening in bond markets, what's happening to the price of debt, mostly government debt, corporate debt, etc. We're seeing the bottoms from 2022 and 2023 confirmed, and now we're starting to see some breakout price action as it becomes apparent to the markets that central banks are done with their fake inflation fight. We saw the Canadian central bank cut interest rates the last week or so. The European Central Bank has cut interest rates, and now the talk is, when will the Federal Reserve cut rates? Will it be in September? Will it be later this year? And the same chatter is following the Reserve Bank of Australia around. And we'll go through as quickly as we can. I have, in the interest of time, pre-drawn a lot of lines and trends on the charts. I've gone over a lot of these concepts before. It shouldn't be amazing to anyone who's been watching my videos or following my techniques that the amount of times we can show support and resistance, divergence signals on momentum indicators, and like wedge patterns and stuff like that. It's a very powerful indicator as to when we should be buying and selling particular investments. So this is the Vanguard Total World Bond ETF. So essentially measures the entire world bond market. Which is a roughly $300 trillion market. That doesn't mean this fund is invested in all of that, but it essentially tracks the global bond market. And you can see this is a weekly chart. So towards the end of 2020, when we're in the pandemic, central banks were printing lots of money to buy up government debt, to push down interest rates, to manipulate interest rates to crazy low levels, to cause the inflation we're suffering from now. And you can see the world bond market had about a 20% decline. And you can see in October 2022, you may recall I put out some videos and I was calling that would be the low in the global bond market. And I understand that some areas of the bond market, such as long-term US Treasuries, did make a fresh low in 2023. Others have not. But you can see here we made the low in October. There's no signal there, but you can see the price made a lower low there, and the MACD and RSI were already diverging higher, making higher lows. So that was a good buy signal. And of course, this 20% is a massive sell-off for the global bond market. I mean, bonds are supposed to be as safe as cash in bank, essentially, or one slight step towards the direction of risk. They're supposed to be safer than real estate. But let's continue with the charts. You can see it came back in October last year to do a retest of that low. And of course, that held, and there was continued positive divergence on the momentum indicators. And now we've seen initially there's some resistance at these levels here. You can see it was struggling to get past here, broke through there around Christmas or the start of this year. And then we've been in this wedge flagging pattern. And if we zoom in, you can see this falling wedge pattern, and that's a weekly candle, big green candle this week to end Friday night or Saturday morning trading our time. So that's a breakout. Now, that doesn't mean it's going straight up, but it means we've formed a solid bottom here. We're getting the breakout. We know central banks are done with the fake inflation fight. If they're not going to be raising rates, that's going to put upward pressure on bond prices. Let's go through and look at the one I got wrong, which was TLT, so US 20 and 30-year government debt. And this has been the most volatile one. If we go back 5 years, you can see, I'll ignore that spike high there, but in August 2020, TLT was trading at $171. The price of 20 and 30-year US government debt to the low in October 2023 went down 51%. That is a massive historic drop. I don't think it's ever happened in history where US government debt has dropped this much in price. So this was a gift from the market in terms of, I mean, we shouldn't have been able to buy the debt this cheap. And it's, of course, because of central bank manipulation. They slashed interest rates to zero. They bought up trillions of dollars of these bonds, and the way central banks push down interest rates is to overpay for these bonds. Sorry, I know I've covered this before, but there may be some new people listening. Please reach out if you'd like to learn more about these concepts. Um, Let me just double check that I'm recording. It's not. Yes, it is. Thank God for that. So you can see the same trend in TLT. In fact, you can see the low in October 2022. Now, you did get, because this market was so weak, you did initially have a little bit of a divergence signal there, indicating that you could buy there. Now, I did buy there for some clients, and you can see that little move there is an 18% move. So you may recall, some of you watching this video may recall that last year we were selling some of our US government debt that we bought, making a trading profit. It, of course, then made a fresh low. So I was incorrect on this particular bond market. It did go down another 11%. But again, we saw this on the weekly chart, massive positive divergence. There's not really many other patterns there other than that it was down 51% and it was crazy cheap for this particular asset. And again, same thing. It had a big rally off the lows. So that was the low in October. You can see that was a 21% or 22% from high to low. So you can, because central banks have destroyed all sorts of financial markets, including the bond market, you can now trade bonds and make a trading profit on bonds. But you can see again, we've got this falling, broadening wedge pattern and then a big green candle breakout now. So again, this doesn't mean that it's going up in a straight line, but it means the downtrend is weakening and coming to an end, and we're starting to see indications that prices are likely to push higher. In fact, I don't know how much that was up on the week. Was that 3.46%? That, yeah, about 3.5% on the week. Let's keep it moving. This is US corporate debt. So the debt of corporations, so corporations issue bonds, and you can see this is again a weekly chart. This was 2021. Again, when central banks were propping up bond markets, you could see the price was making higher highs. The MACD and RSI were negatively diverging, making lower highs. So that's a sell signal. And of course, after a big pump, after central banks Federal Reserve, Reserve Bank of Australia, they intentionally overpay for bonds, and that's the method or the mechanism by which they push down interest rates. So we knew at the time they were expensive, and of course, if you're a client of mine back in 2021, almost none of you owned any government bonds or corporate bonds at all, and that's because they were at a ridiculous price. We had a super low allocation to that. The market started pricing in defaults. You can see this market did bottom in October 2022. It almost made a new bottom, but it held just a bit high. You can see that was the low. Let me just draw that so you can see a bit better. That was the low there, and it didn't quite make a new low, but it was in a sort of a falling channel pattern, and you can see it started to break out. So once it broke out of that resistance, that was a positive sign. Again, price making lower lows, MACD and RSI making higher lows, positive divergence. You buy on the positive divergence. It might seem so simple, but it's amazing how often these signals work. You just have to spend a lot of time watching charts and managing risk and making sure you're well diversified. You don't bet too much on one thesis. And of course, again, we had this trend line here. You can see a touch there, a touch there, a touch. Lots of close trading activity around that resistance level. And as we often see, breaks out from resistance and, quote, returns to the scene of the crime to test the breakout, and then onward and upward it goes. In fact, if you bought, now you probably didn't buy the low, but if you bought the low in corporate bonds, they've already made a 7 or 8% capital gain, plus the yield that you're getting on those corporate bonds, probably about 5 or 6% a year, a little bit superior to cash at bank. Let's keep it moving. This is an Australian government bond fund. The code is BOND, bond. Now you can see again, the low was in June of 2022. So this one actually bottomed here. But again, have a look at how easy this was to get into, how easy it was to buy. You bought the low there, right? Look at this channel it's in. Look at how many times support levels, so floors and resistance levels, ceilings are respected. You knew the low there was in June. MACD and RSI started positively diverging. You got another chance in October 2022. You got another chance in December of 2022. And you got another chance in October last year to buy. And as some of you know, I started buying leveraged bond funds late last year, early this year. Many of you watching this video do have some leveraged bond funds. So in other words, if the price of this is going up 7.5%, we're making more like 10 or 15%, depending on when we bought or sold. Obviously, I'm not smart enough to always get you in at the bottom and sell you out at the top, but you can see again the ceiling there had a little attempted break in April, and we're sort of grinding against this ceiling, and we're seeing other bond markets break out. So we're likely to see this breakout as well, although it hasn't quite broken out yet. But you can see it doesn't want to fall back down. That you can see I didn't even bother extending the line on the chart because I don't think we're going to be retesting that. And I'll jump ahead and show you something. This is the RBA rate tracker. This is where money is speculating as to what the RBA is likely to do. And of course, at the next meeting, which is on Tuesday, is the next meeting. You can see the market thinks there's a 95% chance that there'll be no change in interest rates, and there's a 5% chance of a decrease to 4.1%. There's no chance of an interest rate increase. And you can see here from the graph, this is where the RBA cash rate is at the moment, this dotted light blue line, 4.35%. And these bars represent every month and going out to November 2025, where the market expects interest rates to be. The market is not expecting any interest rate increases from the RBA and expecting cuts, with the first cut likely to start, well, not until next year. We'll see how that plays out. Let's go back to what we were looking at. The Australian, this is the 10-year Australian government bond yield, the 10-year being a very key rate. You can see this was the level from June 2022, and it's back to the same level. And you can see that sort of 4%. I know that says 4.06%, but if we drag it down to about 4%, again, not a surprise that a psychological price barrier like a 4%, lots of activity around there. Look at all that activity. Right, so we had a crack at making a higher high. It did get there in October 2023, but now it looks like it's topping out and starting to roll over. You could even make a case that there was a little bit of a messy head and shoulders pattern there. Maybe you had a left shoulder, a head, a right shoulder, a little bit of a false break, and now swinging back down. Probably going to do. Normally you measure from the neckline to the head, and you're probably going to get a move back down to these lows here of 3.1%. That's the most probable. It's not guaranteed, but that's the most probable outcome. And of course, if interest rates are coming down from 4% to 3%, that means the price of bonds, like this bond fund, is probably going to be doing this. It's probably going to be going up another sort of 8-9% from here plus yield, although the yield is still fairly low. If we look at the US dollar index, the US dollar again, unfortunately, showing a bit of strength, which is not good for for commodities and metals. I've talked in my other videos about we've been reducing our precious metals positions, but this precious metals isn't the topic of this video. So but many of you, if you've been watching my other videos, you're aware. So it looked like the US dollar was going to break down from this pattern, but it's recovered back into that zone. I suspect some of that might have had to do with the European Central Bank, because the European Central Bank cut interest rates. That weakened the euro, and the euro is the second largest currency relative to the dollar. So about half the US dollar index is what the euro is doing. So I suspect it's not so much the US dollar strong, it's that the euro is probably coming under pressure. Probably should have looked at a chart of the euro, but let's not delve into currencies. And again, Vanguard total bond market. So this would just measure the US bond market, not the world bond market. Again, we can see the same pattern. We pick different types of bonds, and we're seeing similar patterns all across the board. If we go to the 10-year US, so the interest rate, the yield on 10-year US government debt, again, let's apply the same straightforward charting principles that we have applied many times before. You can see the price, so the interest rate on 10-year US government bonds got up to 5%, but as the yield or the price was making, it's not the price of the bond, but the interest rate price, what we're looking at on the chart made a higher high. The negative divergence on the MACD and RSI, of course, it was in a bit of a channel there. You can note how those lines are virtually parallel. That's not an accident. And you can see, look at the grind along this line, grinding. And now there's just, I won't call that a break just yet, but it is a close below that level, but a little bit, let's not call that a break. We'd be, I don't like people calling breaks on something so insignificant as a tiny little move below, but you can see it wants to grind lower, doesn't it? It doesn't want to rally back up. It wants to grind lower. And then if we have a look at something that we haven't talked about for a little while is the yield curve inversion. So this is the 10-year versus the 2-year. So I'm using this one because a lot of market analysts prefer this measure, and we've got more data on it. I can go back on this chart to the 80s, and you can see every time the 10-year interest rate was lower than the shorter term rate, the 2-year rate, so below the zero line here, you can see and happened in the 1990s. There was a recession. In 1998, there was a Asian debt market crisis, and then it happened again in 2000, and there was a dot-com bubble bursting. Look at what happened in 2006, just before the GFC. The bond market again is a predictor of recessions, of a crisis that occurred there. You can read this one the way you want to read it, but in July of 2019, about 6 months before the COVID crisis, again, the bond market signaled that there was a crisis brewing, some kind of economic catastrophe. There was a lot of problems in the money and debt markets going on at the time. Let me just see how I'm going for time. I'm going to have to start hustling. And of course, look at where it is now. It's starting to recover. So generally, the recession doesn't start until the yield curve uninverts. Uh, China dumping records amount of US government bonds. And what I wanted to talk about is that once the news comes, I mean, everyone knows they're doing that, but you it's been priced in. It was, if we go back to TLT, the Chinese dumping, it was probably a part of pushing prices down, but it's already been, in my view, priced in. We looked at the RBA. Let's look at the Fed's balance sheet. So this is from the Federal Reserve's website. The Federal Reserve has been selling bonds, so they've been putting downward pressure on bonds. And my apologies, the chart is not loading now that I need it to load. Let's refresh that and come back to it. Here's an example of, sorry, this is not an example. This is from the Federal Reserve's own website. This is the amount of interest the US government pays on its debt. It's now at 1.5, nearly 1,059 billion. So just over $1 trillion. So that's about 1.6 trillion Australian dollars per year. So again, that's another reason why I think bond prices need to go up, is because the US federal government can't afford to pay all this interest on their debt. They need lower interest rates. Lower interest rates mean bond prices go up. Let's keep hustling through unrealized gains and losses. So this is banks. This is from the Federal Deposit Insurance Corporation. So the US government agency that insures the banks, that protects the banks in case of a default, in case customers can't get their cash out when the bank's in trouble. This was 2008, 2009. The banks were sitting on about $75 billion of unrealized losses. Look at where they're at now. It's over, well, it's shrunk a little bit because the bond market has recovered, but this is losses the banks are holding on their bond portfolios. It's about, what's that, maybe about 3 times the size that it was in the GFC, maybe 4 times at its peak. So again, the banks hold all these bonds as collateral. They're in big trouble. They're sitting on hundreds of billions of dollars of losses. If the bond market doesn't recover, if they don't cut interest rates, there's going to be bank failures again. And we saw that last year. I wish I had more time to delve into it. Here's another chart showing that, so the US government, like most governments, they don't pay off their debt. They just keep reborrowing and accumulating debt. In the next 12 months, the US government is going to see 9.3 trillion US dollars worth of its debt mature or expire, which means they're going to have to reborrow $9 trillion. So that's just insane. We don't really have time to unpack all that. And sorry that these are now reloading. This is super core inflation. So, central banks like the Federal Reserve like to talk about, we use core inflation because we exclude volatile elements. Well, core inflation in the US is still 5%. 5%. So even though they need to cut rates to fight recessions, to fight bank failures, to fight the fact the US government can't afford to pay interest on its debt, they still haven't solved the inflation problem. And the US has interest rates higher than us. They've got them at 5.5%. We've got them at 4.35% here in Australia. This is foreign central banks. This white line shows total holdings of US government debt. It used to be 35% of their reserves. It's now only 25%. And of course, they're accumulating gold. I'm going to hustle through because I've only got 90 seconds left. US full-time employment. You can see full-time employment reduced when they had the dot-com bubble, the recession, reduced in the global financial crisis, obviously reduced in the COVID recession. Have a look at where it's been trending the last couple of years. It's now in the red. Again, this is a sign that a recession's coming. This kind of thing doesn't happen when the economy's fine. That would further support the thesis that bond prices are going to go up, because what do central banks do when there's a recession? They cut rates, they stimulate, they print money. This is how you're doing in Australia, real disposable household income, using the Reserve Bank of Australia and the Australian Bureau of Statistics, their data. Have a look at how much your real, so adjusted for inflation, real household income. This is the worst it's been, well, since the chart started in the 1960s. And probably got time for one more chart. China's gold rush. So China selling US treasuries, red line, hundreds of billions of dollars sold. Look at how much gold they're accumulating. Lots of gold. And I better leave it there because I've talked for long enough. Hopefully that gave you a good summary of where the debt markets are at. Thank you so much for listening. I know I had to rush through a few things there. So send me a message. Let me know, hey, John, I want to look at this chart again. Hey, John, can you explain, what's going on with the unrealized losses in the banks? Happy to talk further. And thanks again, and enjoy the rest of your weekend. Cheers.